Hello and welcome to another edition of our IndexMore series, where we at Satrix, together with our partners at BlackRock's iShares, provide you insights around investment trends and the macroeconomic forces shaping our world. My name is Nico Katzke, Head of Portfolio Solutions at Satrix, and I'm delighted to host this session today. As we celebrate the 25th anniversary of Satrix's launching the first ETF in Africa, the Satrix Top 40 ETF, we decided to invite a panel of esteemed experts to discuss whether the investment vehicles and not only the assets we are invested in actually matter. In a year characterized by policy and geopolitical uncertainty, wars and rumors of wars, fluid macroeconomic conditions, and the market's relationship with policymakers that can only really be described as complicated, investors have been left with more questions than answers as to where the opportunities and the risks reside. Today, we cover the year that was, before allowing some time to unpack the reason behind the growing interest in ETFs, both locally and abroad. We have a jam-packed session today, so without any further delay, I want to introduce our panelists. We are joined today, firstly, by an IndexMore veteran, Natasha Sakaria. She's an investment strategist at BlackRock, and she's going to provide insight into market trends and flows for the year that was. Thereafter, Tom Hussman, who is the head of iShares EMEA Core Equity Product Strategy at BlackRock, it's an absolute mouthful, will discuss the uptake of ETFs globally. Lastly, we have the irrepressible Yusuf Wadi, head of exchange-traded products at Satrix, and avid horse breeder, car enthusiast, and also someone that possesses a deep, vast knowledge of our local markets' inner workings, who will provide us with a local perspective on the ETF journey we've had in South Africa over the last 20 years, and also what to expect for the next 25 to come. A very warm welcome to you all, and we hope you're going to enjoy this session. Natasha, if I can start with you. So 2025 was a topsy-turvy year with a lot happening geopolitically, in markets as well as the economy more broadly. Now, we cannot start this webinar without you providing us some insights into the discussions you're having with clients around macro themes and trends, and what provides them either optimism or caution. Natasha? Are we having the dreaded unmute button? Natasha, can you hear us? Apologies for that.
Yeah, sorry, I was externally muted. I was controlling mute from my panel, but someone else decided to mute me as well. Sorry about that.
It's great that you're joining us. Did you catch my question?
I caught everything. All good, thank you. Thanks for having me again. So yeah, in terms of what's been going on from the client side of things, I think it falls into three clear buckets actually. One is that clients actually still do remain risk on, but they're looking to diversify their equity risk. If we think about what clients have been asking us the most, is AI a bubble? Which we don't think, because fundamentals are backing up that price action. And it's how do I manage my AI exposure, my US equity exposure? So really, if you think about it kind of thematically wise, where we started the year, where clients were reconsidering how much of their equity exposure should be US equities. So we're seeing that diversifying equity market risk coming through. And in terms of where they're looking to, in the first 3-4 months of the year, it was definitely European equities. But now into the end of the year, what we're seeing is more and more from actually going into EM. And that incremental unit of risk that's being added is actually going more into emerging market equity than it is into Europe or into the US. So that's the first element. I'd say clients remain risk on. They have concerns about where equity markets can go from here, but they're looking to diversify that equity market risk. And EM has been a beneficiary of it over the past 6 weeks. Second is the changing role of fixed income in portfolios. Now, I'd use that as an overarching theme, not necessarily to describe solely fixed income, but actually portfolios in general. And what I mean by that is duration hasn't really been a hedge, as we've seen over the past 18 months. And credit, on the other hand, has been incredibly stable. So the role of fixed income in portfolios has really been just to lock in income so far this year, and not really as a risk-off hedge. So what we've seen is investors looking to diversify their portfolios beyond that by diversifying into equity income, for example, as well, but also looking into gold as the geopolitical risk diversifier of choice, but essentially thinking about diversifying those diversifiers, not relying on long duration fixed income government bonds, as that hasn't really worked this year. And the third is it's my catch-all point. Clients are now asking us what can go wrong and what can change markets from here, what can cause a risk-off episode in equities, what could cause fixed income spreads to blow out from here. But we're looking to see, and that's catch-all, like it's AI-related, it's fiscal-related in the US and elsewhere in the world, if we think about UK, Japan, and France, and also a story of rate cuts as well. Like, what could go wrong? Could there just be less rate cuts than the market is pricing? Is the market pricing a relatively solid amount or more appropriate amount? And we've seen with rate repricing, especially in the US, even over the past week and 2 weeks, that the market doesn't know what their expectations are for 2026. The Federal Reserve's own dot plots have a high dispersion there, and it just leans into uncertainty. So we are having clients now more frequently ask what could go wrong and how to pivot there. So we've seen conviction coming through, and I can go into this in a minute, in some of the more defensive equity exposures as well. So that's front of mind. I think that's a good thing for clients to be focusing on. So that in my view, it shows that there's a lack of complacency in the market. The market and investors are not being complacent about what risks could proliferate into 2026.
So I like that you mentioned the investors are looking to diversify from the diversifiers, and that the fixed income instruments have been so highly correlated with equities that it is causing quite a bit of pain in terms of the easy routes for diversification. And you almost need to be a bit more creative to get that much needed diversification in your portfolio. That's really interesting. What are you seeing in terms of investment flows across asset classes at the moment? Are investors more focused on long-term allocations today, or are they looking for some tactical differentiation?
So let's start with what's happened this year. We're on track for a record year into global ETPs. So 1.9 trillion, that's the highest on record. That's a very big number. 1.2 trillion of that has been into equities. It's just shy of the record year last year, which was 1.3. We've had almost 600 billion into fixed income and 83 billion into commodities, and both fixed income and commodities are at record levels. But in terms of how much of that is structural and how much of that is tactical, I think when we point to some of the commodity flows, like that gold flows that we've seen, gold was about 60 of that 80 billion, if not more. That's something that's been more persistent this year as investors have closed out their historic underweights and looked to take advantage of its role as a geopolitical risk diversifier. I'd say when it comes to equities, we've seen a persistent buying of US equities throughout the year, less so from the Europe, Middle East and Africa listing region subsection, more so from the US itself. But the US still does lead equity flows, and that's just been pretty persistent, almost 600 billion. What's changed has been the flows to Europe. 82 billion year to date is a record year, and that momentum was really in the first half of the year. That's kind of slowed into the end. And as I mentioned, we're seeing more incremental risk taking in EM rather than Europe. But that doesn't mean that investors have rotated out of Europe. They're still holding that. We've seen that record flow come in, and it's not yet gone out. So that's something that's worth bearing in mind. But looking a little bit more recently, and maybe going a little bit deeper into some of the sector flows that we've been seeing, tech remains popular. And so does a sector like healthcare. And I'd use the past 2 weeks as an example here, less so than actually a longer time period, because what we wanted to see when we were analysing is, have investors been allocating to equities when there's been market volatility? And the answer is yes. So over the past 2 weeks, we've seen 20 billion added to US equities globally. We've seen 2 billion added to US tech, and we've seen around 2.4 billion added to US healthcare. Now, the week of the 15th of November was actually the highest weekly inflow for US healthcare since 2020. So you're seeing investors diversify their equity market risk, even within US equities, they're looking to be a little bit more defensive. It's a sector that we like, ironically, as well. Maybe not ironically, quite logically. So that we are seeing investors start to diversify some of that, but they are still buying tech, and that's worth highlighting as well. What I would say is that overarching on the equity side, EM and defensive equities are starting to win out a little bit more. When it comes to the fixed income side of things, that's been a super consistent story throughout the year of emerging market debt being the big winner of the year. We've had around 70 billion in EMD this year globally, and that's after structural outflows from 2018 to 2024, really. We've also seen very consistent flows in EMEA anyway to credit because it has been so stable across IG and high yield. So investors have persistently added to that. We have seen flows to government bonds and rates still come through. But what's interesting is we are seeing more duration management coming through in those flows, in that they're not just a broad index exposure. It might be a short duration, intermediate or long. And you've seen more tactical rotations between those throughout the year, which is different versus 2 or 3 years ago, where you just see a broader allocation. So you are seeing investors be a little bit more active there.
Those are some fascinating insights. One statistic that you mentioned that's quite eye-watering. You mentioned 1.9 trillion inflows into ETPs. That's bizarre. Remember, that's US dollars, folks. That's a lot of South African rands. So enormous action in that space. And so if we can stay on this topic, so for ETP flows specifically, are they more sticky in the sense that while investors may allocate between different ETP vehicles or ETF vehicles, tactically they tend to remain invested in these vehicles, right? Are you seeing this? And are there asset classes that lean more towards specific vehicle preference, or is it sort of across the board that ETP flows are sticky? So
I would say that it does depend on the exposure and on the rationale behind the investment case. So I was going to give a couple of different examples, maybe to help break this down. One is that let's use Europe actually as an example. So European equity this year, you can argue in the first half of the year was a sentiment trade with Europe outperforming the US, just in terms of broad equity. But when we looked at the reallocation of funds domestically from Europe, Middle East and African investors, that money did look sticky because it was a bigger wave of reallocation, a bigger vote of confidence in the domestic market. We were calling it a repatriation theme. The proportion of that was coming from the US has historically not been sticky, because what we've seen is US investors investing in European equity, for example, tend to allocate quite tactically, and then as soon as that outperformance starts to end, they rotate back into their home market. Now that has happened to an extent this year, but not as much as history. So that's worth highlighting, that I would have assumed that the money that has come from the US would have been more sticky than it has been this year. If we look at something like gold, and again break it down by listing region, I think it's important to do that, because if we look at the US listing region market, that's more reflective, I would say, of a retail investor, less so that what we see amongst Europe, Middle East and Africa, and APAC to an extent also have a high retail participation investment rate. So I would say gold in Europe, Middle East and Africa listing flows probably a little bit more sticky. The US AUM, US listed AUM is at all-time highs. I would argue that if it's at all-time highs, it's questionable how sticky that can be from here on out. So it's less of a one-size-fits-all answer when you're thinking about ETFs and investment vehicles. It's more dynamic than that. But the third thing I would just argue when it comes to ETFs in general is that the increased availability of products enabling investors to be more precise and more tactical means that we are seeing more tactical use cases. And that's something that I think Tom is probably better placed to answer than me, but that's something that we are seeing. I mentioned it in fixed income with duration management, in equities with sectors or factors or single countries in EM as well. That means that we're enabling clients and enabling investors to be more tactical in their ETF allocation and not just set and forget, which we don't think will work for the future.
Yeah, that's brilliant. Thank you for your insights there, Tash. That was amazing. So Tom has entered the room, I gather. So Tom, hello, welcome. You're grabbing the hot seat there.
Absolutely.
Welcome, Tom.
Thank you very much for having me.
So brilliant. So Natasha mentioned some really interesting statistics and just perspectives on ETP flows, but I wonder if you can give us just a deeper unpack, in the type of investment vehicles that investors prefer. So we've seen locally in South Africa growing interest in ETFs, but despite that, the adoption of ETF vehicles has grown particularly fast in the US and Europe compared to South Africa. So, we're noticing it in South Africa, so to speak. I mean, it's been around for 25 years. There is growing adoption, but still in South Africa, there's still more of an emphasis on unit trust. That's sort of the preferred vehicle still. But we're seeing a different story in Europe and the US, right? So does the vehicle matter from your perspective? And what factors influence this decision in the US and Europe?
Absolutely, and thanks for the question. I think there are a couple of questions that you just highlighted, and I'm trying to unpack them. I mean, the first question that you highlighted is a little bit the story for ETFs. So what is really moving the growth between US domiciled funds and also European domiciled funds? The second point that you highlighted is some of the key characteristics and use cases for ETFs. And then the third one is a little bit of comparison of index mutual funds versus ETFs. And I'm happy to unpack some of the questions that you highlighted. Maybe just starting with the first question, and we also prepared some of the slides. So on a slide that you can see where it says the growth of ETPs, it shows the vast growth that we've seen globally. So here's an overview of the global ETP assets under management over time. And you can see that we just reached 18.5 trillion in assets under management globally. So these are all the regions, US, Europe, APAC, and other regions as well combined. So huge growth generally in the ETF wrapper itself. But then if you also look at the pink line, so these are the number of products coming to market. And here again, significant growth of nearly 15,500 of products that came to the market. So there's a lot of innovation, but a lot of choices as well, from the classic index ETFs to factors to sectors to active ETFs. So there's a lot of choice that is coming. But maybe just splitting up a little bit the points that you highlighted on what is growing in the US and also Europe. So the US is making up of this amount 12.7 trillion. So it's the largest allocation. And also when we speak to some of the investments, I mean, historically it has been said that the US has been 10 years ahead of Europe. And that has been kind of like the saying back then. But actually, Europe has been really picking up and really closing the gap in a way, from not just from an innovation point of view, but also from a client adoption and how clients are using ETFs in EMEA. And I'm happy to talk more about this later. And in comparison, it's in EMEA with 3.1 trillion, in APAC 2.2 trillion. So US is still leading, but other regions are coming up. But maybe just to illustrate some of the use cases a bit further, and if we go on the next slide, here we highlighted a little bit the points on what are really the benefits of using ETFs. And maybe just to start with the 2 points of what is very familiar with clients and what many clients are using are single stocks, so just trading on exchange. So they're very liquid, easy to access on a local exchange. Then on the other hand side, we have mutual funds. So think about index mutual funds or also active mutual funds, and they're broadly diversified. So you have the benefit of a basket of stocks that is well defined. And ETFs are the perfect middle ground of both. So you get the benefits of the liquidity, lower trading costs that are traded on the local exchange, so easy access. But then on the other hand side as well, you have the benefits of the diversification, a lot of product choices, and the benefit of getting everything in one single ticker, which would be your ETF ticker. But maybe I think what could be quite nice, and that was I think a key question on the differences, is really highlighting some of the benefits in comparison to index mutual funds. So when we go on the next slide, you can see the overview of ETFs on the left-hand side and also index mutual funds. First of all, both of them track the same index most of the time, if it's indexed. So let's say MSCI World, S&P 500, MSCI Europe, so broad-based indices. So the efficiency of the wrapper is important. However, there are some structural differences. The first one, as I just highlighted, is if it's traded on exchange, you have additional trading cost benefits, but also tax benefits as well. So mutual funds are so that you can only go in the primary market, meaning every time when an investor buys and sells units in a fund, the fund needs to go to the primary market to buy the stocks, which always occurs taxes. So taxes on, think about UK stamp duties, capital gains tax on emerging markets, also higher trading costs. So the cost element is a lot more expensive. In an ETF, because it's also trading chain, so you're handing over the units from one holder to another, you're benefiting from the secondary market liquidity. So some of the taxes and costs are not occurring. And a good example is, for example, an EM ETF. So let's say MSCI EM or EMIMI, where your average trading cost on exchange is between 4 to 8 basis points, compared to an index mutual fund is 40 to 60 basis points. So just because of that, you have potentially nearly 40 to 50 basis points tax savings through the trading cost, which is a huge, huge differentiator. The second point, which is also a key element, is generally the tax efficiency of the ETF wrapper. And that's specifically for US equities, which is often the majority holding in most global exposures or US equity exposures. And here, index mutual funds, and I'm saying, I'm maybe comparing now Irish domiciled index mutual funds or Luxembourg domiciled index mutual funds, they will be subject to 30% withholding tax for US equities. ETFs are subject to 15% withholding tax. So there's a 15% withholding tax advantage. So think about an average dividend yield of 2%. If you're saving 15% withholding tax, that's 30 basis points, so 0.3% per year that you save. So you have many structural advantages, both from a trading, both from a tax, but also from a trading cost perspective. You have a lot more flexibility on how you actually access the underlying, but it's also product choices, because as you highlighted earlier, with more than 15,500 products, you can go very granular in ETFs. You have a lot of choices to, in a way, invest actively. Mutual funds are often just the classical broad market beta exposures. And this is also where all the innovation trends are coming from, so both from innovation, but also from the structural advantages of the ETF wrapper.
Yeah, it's a phenomenally high number, right? 15,500 ETPs globally, and growing, right?
Yes.
And so, we've made the point often when we talk about ETFs with clients is that the vehicles are transparent, it's simple to understand, and so but underlying is the complexity, right? What it is actually tracking and what it is actually doing. The vehicle itself need not necessarily be complicated, but Tom, are you seeing ETFs abroad used more for core tracking purposes or predominantly for tactical purposes?
Yeah, very good question, and thanks for raising this, because we've seen some dynamics shifting, actually, both in Europe and the US. Just maybe bringing this in contrast again, and with the US, I mean, as I highlighted earlier, the way how ETFs are used in the US is in a way a lot more also from a retail base, so end investors, and also advisors, a lot more advanced from an do-it-yourself investment portfolios most of the time. So the use cases from active ETFs to crypto and ETPs, to sector ETFs, to more granular mid-caps, small caps. So clients take very granular views in the US for a longer time. It has been, yes, the core building blocks are very important, but we see definitely a lot more granularity from an end investor perspective. In Europe, and that's a good handover, I think, to the next slide, there's actually a shift we've seen in the last few years that have been moving. So on the slide that you can see here are the European UCITS ETF flows quarter on quarter by the different product segments. So in green, you can see core. So that is your standard market weighted ETFs that you just highlighted, your S&P 500, MSCI Europe, MSCI World, and so on. And you can see prior 2020, a lot of the flows went into the just index tracking broad allocation exposure. So the green parts, before 2020, before COVID. But in a way, 2020 has been in a way the inception year where clients have been more and more using some of the other segments. So we have in pink, we have factors like minimum volatility or value, we have precision, and that are what you highlighted, your tactical exposures. So these are sector ETFs, single country ETFs, mid caps, small caps. So it's all the different ETFs, how you invest tactically, but also granular. So that's the purple color, and then thematics in light blue. So what you can see specifically in 2020 and also 2021, some of COVID, is really how clients invested more actively and granularly in the reopening sectors. So which sectors after COVID have been more advanced in reopening or potentially benefited as well in a new environment, including working from home, tech companies and so on, where also countries as well, some countries that already opened before other countries as well. We have the trade there as well happening, and also mid caps and value have been really in demand. So you can see that the percentage of the flows in precision tactical exposures have been specifically increasing, and then also in the years after. So looking at the last 18 months, thinking about US elections last year, the Magnificent Seven in the US, AI trades, European equities, also defense spending, single country trades on China, India, and being very granular. And so what we've seen previously as a only core or also only low index tracking, clients use ETFs a lot more actively now and more for tactical reasons. And ETFs become, in a way, the toolkit in your portfolio to take these views and get very quick and granular exposures on anything clients want.
I think that's the beauty of ETFs, right? Is that you can actually create quite sophisticated portfolios using transparent, low-cost index building blocks. And that for us is the key as well. Why we are so passionate about bringing these easy-to-understand, low-cost vehicles to market that are sufficiently liquid as well. You mentioned some very interesting things there, Tom, but at the end you mentioned the word active. And I think while ETFs were traditionally seen as useful for index tracking, specifically as investment mandate transparency is key to market making, in recent years, we've seen growing adoption in actively managed ETFs. Now, what is currently the state of play around AM ETFs in the US and Europe? And are there more practical differences when it comes to traditional index tracking ETFs and actively managed ETFs? Are they truly active, or do they mostly feed into existing kind of mutual fund structures as well?
Yeah, very good question. And again, it's important to differentiate between the regions, US and Europe, because there are some nuances, both from a regulatory point of view, but also from an end investor adoption point of view and what is actually in demand. Maybe just starting with what we actually consider as active ETFs. I mean, we just talked about, I can maybe put it in two categories first. The way how clients use our index ETFs first and actively use them in portfolios. So what I mentioned from a tactical point of view. So they take their own views and take an active view in a way. The other element, what you just highlighted, is pure active ETFs. So where the fund itself is trying to outperform the index and to generate additional alpha. And that is a phenomenon that started in the US many years ago. So the US is already very advanced. So the US has currently 1.3 trillion in assets under management compared to Europe with only 87 billion. So Europe is fast growing, but still nascent. But we can definitely learn from some of the developments in the US that are currently coming over to Europe. So in the US, also just from a regulatory point of view, there is a structural tax advantage for active ETFs. So this is why many mutual funds or active funds have been transitioned into ETFs, because they get a tax uplift and therefore also performance uplift. So that's one point. The other element is also transparency of the underlying holding, so how transparent it is. So there you have the option to have fully transparent or non-transparent, where pure alpha generating, like fundamental systematic, can still do not need to share the holdings, where normal ETFs in Europe, for example, currently most of them are transparent, so you show the daily holdings. So for pure active ETFs, it hasn't been so much of a growth, but it's definitely a new category that's evolving right now as well. And the other elements that are happening in the US as well, and we're slowly seeing in Europe as well, is what we consider outcome ETFs. So think about buffer strategies, outcome, where you have options to potentially minimize your downside risk or have also leveraging in some of these funds. So you have the outcome category as well. But then the other one as well is the index, what we call the systematic strategies. So they are often close to the index. So with, let's say, a 1% tracking error target. So you have close to the index, but there's slight tracking error constraints, active bets on single stocks that are systematically driven. And here, this is where we actually seen in Europe so far the biggest demand. So a lot of clients are using close to benchmark, but with a systematic approach. But then the new category that is slowly now also starting are the outcome ETFs. So buffer ETFs and other outcomes that you can generate in portfolios. So to the point, US started a lot more advanced. Europe is coming as well now, and more is coming. And also when we look at some of the global expected flows in the future. So looking ahead, so our expected AUM that we see in the industry globally, so all regions combined. So by 2027, it's around 2 trillion in assets under management. So it's a strong growth. And of that, of the entire ETF industry, 11% are actively managed compared to the rest in traditional index strategies. By 2030, we're expecting the active ETF industry to grow to 4.2 trillion. So from 2027 to 2030, going from 2 trillion to 4.2 trillion. And the percentage of adoption of active ETFs compared to index is moving from 11 to 16%. So again, it's not just the entire market growing, but also the percentage of active ETFs versus index we are expecting to grow. But maybe just to put also again, similar to what we've done earlier with index, the comparison active ETFs and index, to see like what are some of the considerations, and your question of how active are they? When you look as an end investor at some of these products, so index ETFs obviously track an index. So you have an index that you're tracking, and that's how you measure success of the product. And you have index providers from MSCI, S&P, Bloomberg, FTSE, and so on. On the active side, you would have investment teams. So you have investment teams that make the investment decisions, and you also choose from the beginning what's your investment objective. So do you want to have high conviction, alpha generation, fundamental, systematic as well. And then the next point is portfolio design. On the ETF index, it's the index methodology, your index holdings, so how is the index constructed. On the active side is the investment process, so what are the PM and research teams actually doing, and also the underlying portfolio high convictions that they have. And then the common point here, what is really important between both worlds, is the benefits of the ETF reference itself. So what I highlighted earlier of mutual funds, that is both relevant for active ETFs and index funds. Here, the benefits of ETFs are beneficial for both worlds. So you have the tax efficiency, the liquidity, the trading cost, the access, and the product choice that are making these new industries actually grow quite fast.
Thanks for that, Tom. There's some great insights. I'm sure our listeners took a lot of value from that. And it's a fascinating and a growing industry. And we are proud to be working with you guys as well to bring wonderful products to the African continent and provide our clients with access to own the market, to be able to have in their portfolios low cost index building blocks in order to design sophisticated strategies. So thank you for your insights and the great work you do as well at iShares. If I can invite to the proverbial stage my esteemed colleague, Yusuf Wadi, Head of Exchange Traded Products at Satrix. Yusuf, welcome, and congratulations on making your IndexMore debut. I know you mentioned to me in private that this is a big moment in your life and your career. So welcome, and thanks for joining us. Yusuf, I mean, some phenomenal numbers we've seen now. $1.9 trillion in flows in ETPs in the last year. I mean, 15,500 exchange-traded products available. I mean, just some phenomenal numbers, eye-watering numbers. I wonder if you can maybe, you have a deep institutional knowledge of our local market, having been in the industry for many decades. I wonder if you can, Yusuf, just give us a quick highlight reel, if you like, on the historical take on the introduction of ETFs locally, and also whether there's been some regulatory leg ups, I suppose, along the way that have made the case for ETFs stronger over time. Because certainly the reality is we're seeing enormous uptake in the US primarily, but also in Europe. But in South Africa, it's been slower, right? We have seen growing interest in the last few years, but certainly not to the extent we're seeing globally. So maybe give us a historical take, and then we're going to do a deep dive into how ETFs work and go into the real guts of it.
Thanks, Nico. I mean, certainly amazing numbers. I think Tom said it, and we certainly have observed this in South Africa for many years. South Africa's always been a few years behind the US. And well, so I guess to frame Tom's quote, Europe's always been a little bit behind the US, and South Africa's always been a little bit behind Europe. And so it is hugely exciting for us hearing those numbers. We started to see the start of that sort of uptake of ETFs in South Africa that we're kind of seeing globally. For a long time we watched this adoption in the US and Europe, and it's now hit our shores. It certainly hit our shores. The growth in ETFs year on year has just been remarkable. The adoption of indexation has just been one way, and so it's certainly super, super exciting times. But I think more to your question, I think there's lots of reasons why, ETFs have taken up in South Africa. And I think one of the reasons we've seen the growth has just been product proliferation. So if you think back, Satrix launched in 2000. That was the first ETF launched in South Africa. Interestingly, today is Satrix's 25th birthday. So Satrix is now marked 25 years in existence. And it's pretty much 25 years since the first exchange-traded fund. And so in the early days, the first ETFs that the markets has witnessed was market cap indices. Those were the simple things. You come up with a Satrix Top 40, or you come up with our Satrix launched various sector funds like Satrix. The market knows it well. The Satrix Resi that gives you exposure to resources. We've got the Satrix INI, the Indie, the FINI. And so that's been really where ETF started out. It's been super simplistic products that give you broad market access to equity indices, and that's really where the ETF story began. And I think hot off the heels of that, the market kind of was super excited about those products, but product proliferation didn't stop there. Following up from that, Satrix then launched a whole bunch of factor indices. We had the likes of the REFI, the Satrix REFI, the research affiliates fundamental style view of indexation. Then we came up with the Satrix Divi, where you've got a stronger play towards dividend paying stocks, and then followed up with momentum and value. And each time more and more product sets were brought to market, all that happened was more and more eyeballs were brought to the JSE. More and more investors who previously, who were looking for something different now had a reason to come to the JSE and buy and trade these exposures, because these are now super easy ways to get exposures to weird and wonderful things that were previously quite cumbersome to try and build on your own, right? And again, that continued still. Thereafter we saw probably in the 2010s, we saw the range of non-equity indices and ETFs listed. We had inflation-linked bond ETFs, government bond, money market ETFs. Again, still, that was followed up by multi-asset class indices, where via one ETF you can buy exposure to an entire basket, right? So in your ETF, you could buy exposure to local equities, offshore equities, local bonds, offshore bonds. And so, product proliferation had a huge role to play in terms of the uptake of ETFs, because with every passing year, you just had more and more issuers bringing more and more, exciting products to market. Another factor that I think can't be overlooked has just been the importance of legislation. Certainly legislation does play a role in making the market more accessible and more easy. So again, if I think back, if I think back on the last 25 years of Satrix's journey, in the first 15 years, so from 2000 to 2015, the growth in our ETFs were pretty much organic. So we would see clients who had interest in ETFs, or certainly had interest or desire to be exposed to financial markets, certainly used our ETFs. But the interest was organic. It was probably single digits year-on-year growth. But what was interesting is that
and then you arrived, and it just...
well, not quite. I was gonna go a slightly different direction, but what actually happened in 2015-16, and this talks to the importance of deliberate legislation and what it can mean for creating a very friendly investment destination. Around that time, the South African Reserve Bank, formalized the ability for collective investment schemes or issuers like Satrix. They formalized the ability for issuers like ourselves to inward list offshore exposed ETFs. So up until then, there weren't much options on the JSE in terms of, let's say, getting exposure to the MSCI World or the S&P 500. You pretty much only had by and large, there was probably just one issuer that had product in the space, but by and large, there wasn't a great variety of choice in accessing these amazing offshore exposures. And so, in 2016-17, the South African Reserve Bank allowed the inward listed, the possibility for Satrix and other issuers like us to inward list offshore exposed ETFs, and that has been remarkable. I mean, to give you an idea, so as soon as that happened, we've seen a amazing, proliferation of offshore product in the last, since 2017. So probably seven or 8 years. We've seen all sorts of exposures being offered. From NASDAQ to sectors like healthcare or ESG, global ESG indices, to the extent that in the last 7 or 8 years, if I just take Satrix's case as an example, we've raised more assets in offshore exposed ETFs in the last 7 years than we have raised in local assets for the last 25 years. And I mean, so that just talks to the importance of of legislation. And again, I think we're still seeing very active legislation, and we're seeing very forward front foot thinking from our regulators. 2021, 2022, they applied their minds off the back of international growth. They've applied their minds to what it would take to launch active ETFs. And since then, it's been an exciting space. We've seen a lot more activity come to the JSE. We've seen a lot more players, and that brings more product. It brings more ideas. It brings more volume. And so it's been legislation has been super supportive again, and still it doesn't stop. Right now we're in the middle of a cryptocurrency legislation with the Johannesburg Stock Exchange, and there is a draft set of regulations that's currently being circulated at the regulator. And so I think following on from positive feedback from both the regulators and the private and from business, I think pretty soon we're going to see regulation and we're going to see cryptocurrency ETFs on the JSE.
So, and I guess if I can summarize, if I can just jump in there. So I think you've made two very interesting points. I think regulation has eased, and that has allowed us to bring to market more. You mentioned product proliferation, but I mean just choice to the market, right? And that choice itself creates excitement. It creates awareness, and we see investors using it to build sophisticated low-cost portfolios, which is ultimately what we're trying to achieve. But another interesting and very important point is the access point, right? So platform access is a very important consideration as well.
Yeah, spot on. I mean, we've said it many times, and Tom and our colleagues from BlackRock could testify to this. So. When it comes to indexation businesses or ETF businesses, one is you need great product. You always need good product. You always need to be solving something for your clients. But the success of these businesses have always been an exercise in distribution. It's all about coming up with a product, but you have to think about the holistic solution. How do you get good product to your investors in a way that's usable, accessible, it's easy for your investors to transact, to manage, to think about. And so distribution is absolutely key, and it touches on your point. In the early days, back in 2000s, the only way you could buy ETFs on the JSEs was you needed to have a stockbroking account. So because the ETFs live on the JSE, so you go to your stockbroker and you transact and you buy and sell ETFs the way you would buy shares. But very, very, very soon after that, a lot of issuers, certainly Satrix, came up with investment platforms. Back then we had the Satrix investment plan, whereby you'd open an account directly with Satrix on via website experience. You'd go through the Satrix investment plan and you would take out your debit order. But this, innovation hasn't stopped. Since then, we've launched Satrix Now, which is a much more, digital experience and, available to our clients in app form or website form. Apart from Satrix products, you've got a host of, interesting, weird and wonderful platforms out there, whether they are robo-advisors or other, independent platforms that are channeling investors into products like ETFs. And so all this just simply adds to ETF take-up, because it serves to socialize ETFs. It serves to take ETFs deeper and deeper into the rest of the market, where previously they probably wouldn't have had exposure to such instruments. But I think possibly one of the biggest developments we've seen when it comes to platforms has been something that Satrix has rolled out recently. We've spent a lot of time implementing a LISP strategy, whereby we've come up with a solution where we can onboard Satrix ETFs, our ETFs, onto LISP platforms. And again, this was a very difficult thing for many years, and still, many LISPs aren't able. Well, historically, LISPs were not able to offer ETFs on their platforms for lots of reasons. However, we've come up with a solution, and now this has been one of our strongest, growth areas. We've seen remarkable inflows and AUM growth across the list. So Satrix ETFs are available across all major lists, and again, it talks to the distribution. The importance of distribution and the importance of ensuring that your clients are that your products are readily available to your clients.
Absolutely, and to that point, since introducing or adding our ETFs on lists, I think 5 years ago, it's currently eclipsed the 10 billion rand AUM mark already. So in other words, 10 billion rand of AUM accessing ETFs through lists. So a wonderful technology that Satrix again pioneered, and it's available on all the major lists, I think, barring one. But speak to your providers. I mean, it's something that we are working very hard to bring to all our clients. It's just the ability to have your end clients access our ETF range, which again just provides, to your point, Yusuf, it provides access, it provides opportunity to build portfolios using a wide array of ETFs. And we're certainly seeing that happening abroad. Tom made the point. The uptake is just enormous. And investors are realizing just how powerful it is to actually put together low-cost building blocks. We've used in the past the analogy to say it's like Lego blocks. Lego blocks itself are cheap, very simple to use and understand, but you put them together in the right order and you can create phenomenal creations. And so that's ultimately what we want to bring to market. It's just choice, right? Just the availability of various products that our advisor clients can put together solutions for their clients ultimately. And the list platform access is a wonderful technology that we've brought to market. I want to pivot slightly, Yusuf. And locally, ETFs have mostly been seen as synonymous with rules-based index fund strategies. Right? The Satrix Top 40 was the first one, and you mentioned a few very simple. Tom used the word precision ETFs, so sector tilts, for example, very simple strategies. But more recent regulations have actually allowed active strategies to be housed in ETFs as well. And since then, we've seen a proliferation of AM ETFs as well as AMCs. Which are both exchange-traded funds with active underpins or active strategies. At least in name, it allows itself to be active. But as of now, it's predominantly been income funds that have listed actively managed exchange-traded alternatives. Now, what's your take on the challenges as well as the opportunities for managers in this space? And are there reasons to consider wrapping a truly active fund in an ETF vehicle? And what is the challenges that managers face doing so?
Yeah, Lucas, it's certainly a very interesting space, and it's been one of the places of the JSE where we've been seeing lots of listings locally. I think when it comes to actively managed ETFs, you can kind of think of it in two ways, right? So, one from a traditional index house like Satrix. So from an index house like Satrix, there are two types of AM ETFs that you could possibly start seeing being brought to market by an issuer like Satrix. Number one is, and I think we've touched on this earlier. There's been a huge proliferation of various types of products on the JSE for ETFs. A whole weird and wonderful list of exchange-traded funds, but we've always said it that it's very easy to index an equity space. It's quite simplistic to come up with an index that is replicable. Likewise, on the bond side, it's very easy to look at the bond market and come up with an index that's you can invest identically to that index. The part where it is a little bit more difficult has been in the short-term fixed income space. I mean, so if you look at instruments there, you've got stuff like promissory notes, you've got NCDs, you've got a whole bunch of credit-linked notes. And these are all instruments sort of anywhere between 30 days maturity and let's say 18 months. Now,
the money market type instruments, right?
Exactly that. It's exactly the money market type space. And the problem with indexing this market is that whilst you can come up with an index that describes the performance, and I think the viewers will be very familiar with concepts like with the STEFI index as an example. The problem is that the STEFI, apart from just being a calculated benchmark that gives you running performance, the STEFI in itself is not a replicable index. So you cannot look at the STEFI recipe and invest alongside in exactly those same weights. It doesn't quite work like that. And so there's been lots of attempts to try and come up with indices that replicate that part of the market. Some have fallen short. Most of them have fallen short. But I think there's certainly still attempts to do so. But it's an interesting space, and it's a very obvious application for an actively managed strategy. And I think that's the reason why you're seeing so many actively managed strategies launched in the space, because for all the challenges that one has in coming up with product that tracks this part of the market. And I think that's certainly going to be an interesting space. There's been lots of products. I know we at Satrix are looking at a few products in the space, and hopefully we'll see something soon in the market. Another type of actively managed ETF you're probably going to see in the market, again, from a classic issuer like Satrix, an index player like Satrix, is sort of quantitative-based strategies. So these are strategies that, for whatever reason, they just don't fall inside a traditional index. Either they're a little bit more complicated, or either index rules pushes them into the AM ETF bucket. Tom talked about buffer ETFs. So these are just ETFs that have a defined outcome. So, an ETF, imagine an ETF that says you can never lose more than, 80% of your net asset value. So there's an inherent floor, there's an inherent, guarantee, or you could also get index plus ETFs. Now at Satrix, again, a lot of these products have been available in unit trust form. So Satrix does have products like this in unit trust form. But again, you could start seeing products very soon like this in ETF form, almost quantitative strategies with a strong quantitative slant. Again, very much passive, very much index, very much quantitative. And so that's another subset of the market, right? I think what you alluded to, and this is certainly some of the more, recent activity we've seen on the JSE has been a little bit different. It's been more from the active houses. So you'd see traditional active managers who are now bringing to market ETF versions of their products. And that's an interesting thing, and one can understand why that's happening. ETFs have a tremendous appeal, for all the reasons we mentioned, the growth in the US and Europe, the numbers are just, are sort of out of this world. And so, active managers are kind of, looking to they're looking to be part of their party. They want to benefit from the key tenets that ETFs enjoy. Costs. ETFs by their nature structurally has lower costs than a unit trust, and that's because ETFs don't have platform charges built into them, while unit trusts have platform charges built into them. Access. ETFs are available to everyone. So, for instance, to give you an idea, the moment we list an ETF on the JSE, in theory, it pops up on everyone's Bloomberg around the screen, around the world. The moment you are listed on the JSE, you are available pretty much everywhere. A unit trust don't really enjoy that level of access. When you bring a unit trust to market, you're possibly available on a list or a few lists, or maybe just on your management company. ETFs has this promise of unlimited access that once you plugged into an exchange, really anyone can at some point can get access to your product. Then, of course, there's just the brand value attached to ETFs. ETFs have a huge brand value attached to them, and you can kind of see why a lot of these active managers are bringing ETF versions of their product. Because they want to try and sell to all this brand strength that we're seeing in the ETF market. And then, of course, in South Africa, there is some structural advantages that ETF managers enjoy over unit trusts. So, for instance, an ETF can list, in theory, an unlimited amount of offshore assets on the JSE, and there's no hard cap. So there's no cap on, in terms of how much assets we can bring to the market, let's say referencing some global market, where a unit trust cannot. Unit trust has a finite capacity in terms of offering. But I think what's interesting is having said that, once these managers, do come to market, I think there's still a journey for in trying to appreciate, what it takes for true conversion. Listing is one thing, but you have to navigating the listed world is slightly different to navigating the unlisted world. It's all about, how do you sell your product through stockbrokers? How do you, you now need to build a direct-to-consumer play. In many ways, if you listen on the JSE and you try to sell to the market, you have to appreciate the strength of the retail brand and how do you crystallize your value proposition. So it is certainly interesting. I think it certainly brought a lot of activity to the JSE, which I think ultimately just deepens our markets. And so it's an interesting space.
It is fascinating, and I think you alluded to the fact that there's a offshore capacity element that some cynics might point out to the reason why there's this, I suppose, growing interest from managers to list actively managed ETFs. There's another point that's interesting, and I think clients might worry about as well, is the benefit of an ETF might also be its downfall in the active space, right? So the benefit is that it's transparent exactly what is in the ETF, and you need to know what is in the ETF throughout the day to allow the market maker to actually create and redeem the instruments, right? So it's maybe important for our viewers just to explain what I mean by that. So when an ETF is created, the market maker plays a critical role in ensuring liquidity by being able to replicate what is in the ETF through the day in order to create and redeem existing ETFs. Now, if it's an actively managed strategy, I suppose the manager would have a strong incentive to retain their secret source, and in terms of what is in the investment vehicle. And so once you list it and it is available, publicly available, and throughout the day, you know exactly what is in the fund, and more critically, the market maker knows how the fund changes through the day. Are there practical considerations, and should investors be worried when they see active managers listing AIM ETFs, or is it something that can easily be overcome?
Yeah, Lucas, I think that's been. Those are the challenges initially when regulation was drafted. But I think the JSE and the market has come up with pretty novel solutions around that. There's a concept of INAV. So I think the market will start becoming familiar with something called an INAV, which the JSE's put in place as part of the listing requirements for an active ETF. You've got to put out an INAV, especially for non-disclosed active ETFs. And the INAV is, what it is, it's a real-time intrinsic value of any particular product or ETF. So real-time, you've got an independent valuator calculating the true intrinsic value of this ETF. And it serves to guide the market. It serves to guide the market, and it works pretty well. So I think in that regard, the JSE has certainly applied their minds in crossing any possible minefield that would have existed. So I think it works pretty well.
Joseph, we are very quickly running out of time, unfortunately, and it's been a phenomenal deep dive into ETFs, all things ETFs, and how it works. I'm going to give you 1 minute to answer a very hard question, but going forward, do you believe our local asset management industry will continue expanding the availability of ETFs? And are we going to see growing interest as we are seeing in Europe and the US locally?
Look, absolutely. We've seen, certainly at Satrix, we've seen unprecedented growth. I think, in the last few years, the flows are testament to the wide-scale adoption for indexation and ETFs. And it's been from every part of the market. It's been from the retail part of the market, from the institutional part of the market, from the intermediated market. It's been extremely broad-based. Okay, so, that's number one. That's on the face of it. Number two, as long as the macros are in place, and by that what I mean is, ETFs bring a hallmark of a key there's a key set of tenets that the ETFs enjoy, and right now, as long as that's in place, investors will simply just gravitate towards ETFs. So ETFs are transparent, and that's a huge selling point. It's clients, it's very easy for clients to build trust and understanding in what they're investing in, and that can't be underplayed. Trust is a big thing, and transparency, I guess, transparency is always the ultimate form of trust. So that's a key feature of ETFs. Lower fees. Structurally, ETFs have lower fees for lots of reasons. Access. And so as long as these key tenets are in place, ETFs will always enjoy, ETFs will definitely enjoy these tailwinds, right? On a second up, we're seeing issuers. Issuers are now more than ever looking to enter the ETF market, and so they're also providing a huge tailwind. So you've got the macros in place, you've got issuers bringing more product, and I guess ultimately clients are gravitating towards exchange traded funds. There was a stat, and this is commonly quoted, that if you look at a certain segment of the market, I mean, if you look at millennials, defined as the slightly younger than average part of our investment cohort, millennials continue to allocate the greatest share of their portfolio to ETFs, and that is a profound statement, because as this cohort grows up and becomes a bigger and bigger share of the global AUM pie, you're going to start, we've got strong support in that there's a big part of the investment world who have grown up with ETFs, understand ETFs, and enjoy all the features that they've come to expect from ETFs. And as they get bigger, I think we're just going to start, we're going to continue to see ETFs go from strength to strength.
Phenomenal. Thank you, Yusuf, for your wonderful insights. Tom, Natasha, it's been an absolute pleasure hosting this webinar and feeding off your energy and your wonderful insights. Thank you so much for that. And to all of you listening at home, we hope you enjoyed this webinar. We hope you learned something new. And for the next 25 years, we hope we at Satrix will be able to bring to market interesting and innovative products and continue helping our clients own the market at a low fee and with ease of access. Thank you at home, and we hope to see you soon again with the next IndexMore webinar, which will be scheduled for early next year.